this is quite a daunting crowd. I see a lot of people who know a lot of stuff about this topic here. So please do help me out when I get stuck. But I guess just to kick us off, so first of all, to explain why we're bringing together this group of people today, Charlene mentioned the long-termism deep demonstration. So this is a project that EIT Climate Kick has really facilitated over the last couple of years. I will let Anne and Jakob and Raj probably speak more about it there. They've been more deeply engaged, but this has been basically pulling together a network of partners internationally, all of whom have quite different interests in this topic of long-termism, but looking at how do we really start to shift the system, and how do we take an approach that is about pulling together a portfolio of experiments, if you like, and different types of intervention to start nudging our financial, economic, and political systems towards a more long-term orientation. And we as Volans have been involved in that deep demonstration and doing some of the thinking around it for the last year or two, and we'll be publishing a paper later this week to set out some of conclusions we've come to through that process of research and engagement with not just the members of the deep demonstration, but also a bunch of other partners, including a few of you on this call, I think. So the problem, I don't need to tell this audience why short-termism is a problem, but one of the things we're big believers of at Volans is that in order to be effective at addressing a problem, you have to understand the root causes behind it. And there are lots of factors. I'm not going to go into all of them because I want this to be a discussion, not a lecture behind this. There are aspects of law, of regulation, of business models, of incentives, all of which lock us into short-term ways of thinking and acting. But actually one piece I want to focus on for now, and this is something we've looked at quite extensively in the paper we'll publish this week, is the piece of that story I think that doesn't get as much attention as it deserves, and partly because it's quite technical, and that's about the way that short-termism is actually encoded into some of the tools and models we use to make financial and business decisions. And so apologies to those that have read the blog I posted this morning. I'm going to recap a few of the things I say in that, but let me introduce you to some acronyms that if you work in finance, the first two of these will be very familiar. So apologies for the layman's approximation of them. But first acronym we want to talk about is DCF, discounted cash flow analysis. Now, this is one of the oldest tools in the book, if you like. As soon as humans started investing money, which is the core of capitalism, they needed a way of determining what was a good investment and what wasn't. And discounted cash flow analysis was, in effect, the solution to that problem that we came up with really back in the 18th century, and it's evolved relatively little since then. But DCF analysis makes certain assumptions and leaves certain things out in a way that's now proving problematic. When you have an entire financial system built around the use of that type of analysis, it ignores the need to preserve stocks of social and natural capital. There's just, in effect, there's just no cell in the spreadsheet for those things, so they get ignored. And obviously, as the name suggests, future cash flows are discounted. Now, there are all sorts of good reasons for that, but the consequence is that because today's cash flows are assessed as being worth more than next year's, which are in turn worth more than the year after's, and so on, both investors and businesses are incentivized to focus more on the short term than the long term. So that's a kind of one of the tools that is just endemic in our financial system and has been for hundreds of years, that is encouraging us to narrow and to shorten our perspective. A second acronym we talk about is MPT, modern portfolio theory, still called modern portfolio theory, even though it's 70 years old. And when it was first introduced, it was a real breakthrough for the investment industry, right? It paved the way for the index investing revolution that's given us firms like BlackRock and Vanguard that are now massive. But again, there are certain both assumptions and omissions that make modern portfolio theory potentially dangerous for where we are today. And one of the crucial assumptions it makes is that investors can't influence the risk return profile of the market that they're investing in. Investors, in effect, are just passive. They surf the waves. They don't make the waves. And this made a bunch of sense back in 1952 when modern portfolio theory first emerged. At that time, the vast majority of shares were owned by individual investors who definitely didn't wield enough influence to influence the performance of the whole market. But obviously that's changed now, and most shares are now owned and managed by massive institutions that do have huge clout, not only to influence the behavior of the companies they invest in through stewardship programs, but also to influence policies and regulations and the way that the rules of the game are framed. But again, the adherence to modern portfolio theory basically tells them not to exercise that power. And then third and final acronym, this will be more familiar to those who aren't in the finance space, SVM, or shareholder value maximization. I think most people on this call will be kind of familiar with the Milton Friedman article in 1970 that said the social responsibility of business is to increase its profits. And to be fair to Friedman, he left open in that article the possibility that companies should do things that may not produce immediate returns if they were likely to pay off in the long run. But what then happened as that theory was turned, or as that idea was turned into a more formal academic theory, particularly by two business school professors, Jensen and Meckling, who wrote a famous paper a few years after Friedman's op-ed. They were more insistent that shareholder value maximization meant shareholder value maximization right now. They argued that the only meaningful measure of a company's value was its stock price today. And so that's the only thing that management teams should focus on. And anything that doesn't affect the stock price today isn't worth spending time on. Now, there are lots of other theories and models that underpin our short-termism that I could talk about, but I think these three, DCF, MPT, SVM, are really crucial to understanding why today's capitalism systematically ignores, frankly, the reams of data. You know, we've just had the latest WEF global risks report, which yet again puts climate, biodiversity, extreme weather, etc., at the top of the list of long-term risks we face. We don't have a lack of data about these things, and yet we seem to be systematically incapable of acting on them, and that's why long-termism is so important. So last thing I'll say is that means we're going to have to find ways to do stuff that is totally unjustifiable using these old models and theories, that looks frankly crazy when you look at stuff through a lens of discounted cash flow analysis or modern portfolio theory or shareholder value maximization. And that for me is part of why projects like the long-termism deep demonstration and the work that both 2DII and Dark Matter Labs are doing in this space is so important, because frankly, some of it does look quite crazy from through the lens of those old paradigms. So let me stop there.
Thanks, Richard. Does anyone else on the panel, so Anne, Raj, Jakob, do you have anything else to add on kind of systems and processes that are keeping us in this sort of short-term looking horizon?
Yes, maybe I would like to add like just a different perspective also. First of all, Richard, like thanks a lot for this. And I also really recommend reading the paper, because I already had the privilege to review it and I found it great. But I would really like to also go beyond the financial system here, right? Because I don't even think it's like only a financial system problem. And I think we all kind of know that we are biased to the short term. So like all of us know the feeling of, okay, hey, I'm living today. I don't know what's going on in 20 years. I just had a call with like a good friend, and we are talking about like, maybe we need some insurance for like what's happening in like 20 or 30 years. And we were like, okay, everything is like so uncertain. We don't really know if we want to have insurance or not, right? So I think it's for everyone, it's like kind of hard sometimes to look into the future and to value the future also over the short term. So I think like really to sum it up, I think there are like three things or three issues that like make us focusing more on the short term. And that's like, first, that there might be not the many incentives that we need to look into the future. And now also with regards to like policy making, like if we look into like policy cycles and so on, like they don't look over the 4 years or like 8 years, or that they are like re-elected or not. Then the second thing is like really this uncertainty problem, so that we might not be able to really know what will happen, and like then this kind of like really avoids us of looking into the future as well. And then the third thing is also that like future generations can't speak, right? So that we can't like really, like they are not taking maybe into some decisions because we just don't really like hear their voice and like, yeah, really take into account what they want to say. So I just wanted to like add this, that I think, yes, of course, like it's really important that we look into the roots of within the financial system, why the financial system is so short-sighted. But then again, like I think it's like a more cultural and also more maybe psychological phenomenon, which also goes beyond the financial system.
Thanks, Anne. Jakob?
Yeah, just to add, I think one of the comments as well in the chat about what actually means long term, right? And I think that's a really important part of the conversation. It's because it drives two things, right? It drives, well, you know, what are we talking about? At what point does this become an issue? And the other thing is, at what point is there a value to being long term, right? So we're actually doing some work that's really interesting about where we surveyed these 60 investors and just asked them a simple question: what's the time horizon of a long-term investor? And you get everything from plus 10 years to 1 to 3 years, right? And what I think is also interesting about that is when you then drill into these answers, you realize that an investor might have the appreciation that the investment horizon would be 10 years. So you have an investor who says, yeah, it's more than 10 years. And then we ask them, or do you consider yourself a long-term investor? And they say yes. And they say, what is your time horizon? They say 3 to 5 years, even though they've just in the same survey a minute ago said the time horizon is 10 years. So I think it really just goes to show how important it is to actually nail this down. And one way we think about the logic of long-termism is where long-termism is artificial and where long-termism or short-termism is artificial, where short-termism is real. So artificial short-termism is if you have 20-year liabilities and you have performance incentives that are 1 to 3 years. That's artificial short-termism because it's inconsistent with your own incentive set. Artificial short-termism is if you have 20-year liabilities, but you're investing in market cap weighted benchmark indexes where the price formation mechanism is driven by short-term investors that have 1 to 2 year time horizons. And that I think is important because it also means there are certain moments in time where short-termism actually has a utility. We don't talk about this now because we're very worried there's enough short-termism as it is, but just to recognize that, you know, listen, hey, sometimes if you have a 6-month time horizon, just to go back to Anne's example, when you have 6 months to live, then maybe it makes sense to live in the moment. And if you've got 40 years to optimize, or 50 or 60 or 70, maybe it makes sense to think a little bit more long-term. And I think that consistency is missing, where investors think they're long-term as a function of having long-term liabilities, but not recognizing the artificial short-termism they introduce in their decision-making.
Thanks. Raj, do you have anything to add on the problem?
Yeah, thank you. I think this problem is definitely, it's multifaceted, but I think it does, and I think we've all said it so far in a number of different ways, that it's what we value, and whether it's the institutions that we develop as a society or the instruments that we use to contract or financialize with, they are based on a bias, and you know, we may say we care about the future, but yet we seem to have no issues about imposing liabilities on generations that are not even born yet. And if going back to you know, the whole concept of net present value, or DCF as others call it, if you just look at a simple instrument as a bond, it's the first thing that you really want to measure is that you know, you learn in finance 101 is that $1 today is worth more today than it is worth tomorrow. So therefore, if you look at the duration risk of a bond, it's a weighted average cash flow, and the cash flows that are closer to the present are more valuable, quote unquote. And I think that's another reflection of what we as a society value in terms of wanting something today at whatever cost. And then we use the excuse of uncertainty. And I call it an excuse intentionally, because I think apart from maybe some mathematicians and some physicists and maybe a few writers, uncertainty is something which we deplore. We're very scared of it. Yet, if you really understand it, it's something that we all live with, and will continue to live with. But that does not give us an excuse not to think about an ultra long-term future, just because we have this. So I think uncertainty it's that wonderful area where we can drop everything into that bucket and say, well, it's undiscoverable, it's unknown, there's not enough data. We know from the social sciences, especially with Max Weber, and reality is an infinite stream of data, and it's whatever parameters you put, and everything outside of those parameters is meaningless. And I think we do that in the institutions that we create, as well as the instruments that we create too.
Thanks, Raj. Okay, so before we move on to sort of the practical ways that we can create a more long-term economy, should we talk a bit about what that actually looks like? So what does long-termism, what is that to you, and what does it look like in practice? Can we start with Anne for that one?
Yes, sure. So to answer this question, maybe I would like to repeat one more time why we actually want financial systems or the economy to be long-term, right? So we want them to finance like mitigation and adaptation measures, or like new ways of producing, like keywords, circular economy, including planetary boundaries in our economy and so on. So we really want them to be prepared, or like to help society to be prepared for those long-term risks that Richard just mentioned in the beginning, like biodiversity losses, climate change, ecosystem services losses, social conflicts, and so on and so forth. And here I think that like long-termism, like when we just think long-termism as a time frame, so like really from like, I don't know if we define it from 1 to 2, like or beyond 3 years, let's say, or like beyond 10 years, that this is actually not enough. So I think like, and I think how we also think about it here at CDI is that long-termism might be a necessary condition, that financial institutions like look into the future with a longer time horizon, but it's like only a necessary condition and not a sufficient one. So what I mean with this is, I mean, like only if investors are now looking in the future and look beyond 1 to 2 years, I think it doesn't mean necessarily that it helps society. So we had, and to give you just an example, so we had a meeting with an asset manager half a year ago, and he was like super interested in our work on physical risks, and he was like because he was investing in land and was especially interested in like water stresses. And his core motivation was to use our models to identify today which land he is like the most profitable one in like 10 years. So he wanted to know from us how exposed his investment today is, so that he is able to shift now his investment away from the most exposed regions to the safer ones to gain like an advantage compared to other investors. And I think in that case, you really can see that he was able to incorporate the future, right? He was looking in like 10 years time, but he didn't really like did a decision that I think like benefits society in that case, because he just pulled his money, or like he wanted to pull his money out and put it like somewhere else, leaving the exposed region or exposed lands behind, and maybe with not enough money to really like do mitigation and adaptation measures. So I think, as I said before, like long-termism from like just a time frame component, so when we like define it from like, I don't know, beyond 10 years or not, is not enough, because for like for like shifting the financial system or the economy in a way that it actually benefits society then overall, or that we are really prepared to those future challenges in society. So I think like it answered like half of your question. What it's like, not like, it's not only the time frame, it should be something more, or it's even the time frame, but then we shouldn't like actually then I think we should like not say like we need a long-term focus to have like society prepared for it, but it's like only the necessary but not the sufficient condition for it.
Thanks, Anne. Richard, would you like to?
Yeah, if I can pick up on a couple of things Anne said. So first of all, on the time frame dimension, I mean, it's really interesting to hear about the survey you guys have done of long-term investors and the differences within that. But I'm also, every time I have this conversation, I also like to bring up, lots of you will have come across the book, The Good Ancestor by Roman Krznaric. And he defines long-term in that, so he comes at this from the perspective of a philosopher and kind of a moral philosopher rather than as a financier. But he defines long-term as 100 years or more, because in his view, long-term has to mean thinking beyond your own lifetime, or the lifetime really of anyone alive today. And of course, 100 years is very, very different to the kind of long-termism we are talking about mostly when we talk about this in a business and finance context. I saw somebody in the chat reference quarterly reporting, and I would say, we've obviously seen a number of companies over the last decade and more move away from issuing quarterly earnings guidance, and I'm in favor of that because that does take some pressure off the need to be super short term in decision making. But ending quarterly earning guidance is, barely scratches the surface when we're talking about issues that play out over decades rather than over months or even years. And I think so. The other thing Anne mentioned that I think is worth picking up on is planetary boundaries. I think it's really important that our understanding of long-termism today is also based in what we know about the situation we're in today, and what we do know is that we have already overshot multiple planetary boundaries, and we have a very rapidly declining carbon budget, to name just a couple of the issues. So in a sense, I think the elephant in the room, if you like, is growth. Somebody referenced GDP in the chat as well. This year, as lots of you will know, is the 50th anniversary of the original Limits to Growth study that the Club of Rome commissioned and was published back in 1972, which tried to warn us then that limitless growth on a finite planet just wasn't going to work. And of course, the science has moved on quite a lot since the 1970s, but their basic conclusion keeps being broadly validated by more recent studies. There was a big review last year led by the economist Partha Dasgupta on the economics of biodiversity, which basically echoed the message of limits to growth. He said, because the biosphere is bounded, the global economy is bounded. That's the basic logic we have to deal with. There have been other studies, an attempt to revisit the limits to growth models and kind of look at how they track against data in the interim and where what the different scenarios are from here. And essentially the conclusion from that, again, was that we're currently tracking an overshoot and collapse trajectory, probably with only a couple of decades left before we enter the collapse phase, though we still have time to make it a softer landing, if you like, or a sort of managed retreat, rather than what could easily be a humanitarian catastrophe if we don't get our act together. So I think in the context of where we are today in 2022, I absolutely agree. I don't think we can talk about long-termism without also incorporating the lens of needing to live within planetary boundaries, which in many cases means needing to retreat back from where we are today, without necessarily wanting to get too far into the growth versus degrowth debate.
Thanks, Richard. And I like this comment someone shared. Long term is made up of many short terms. That's what I would have said it when I was working in finance. I thought that was great. Raj, do you want to talk about what long-termism means to you?
Actually, I wanted to, regarding this, the whole concept of the limits, even if we understand what those limits are, and even if we're able to quantify those limits, I think what we still are not addressing is the actual dispersion of value within that system. So yes, any model or any system will have boundaries, and even if those boundaries are dynamic, there may be a limit to what that system value holds. But I think it's also the skewed distribution of that, and the way that we value things, and also using a simple example of an investor that says, I expect the following returns. If you look at the asymmetry of that relationship is already embedded in the actual transaction itself. So you have an investor who has certain expectations, risk return expectations, and due to that, there is an asymmetry right there in terms of investing in, say, a generative long-term asset, and what your expectations are. Even if your expectations are relatively on a longer horizon, the value that you're trying to either create in a system, still the distribution of that value is quite skewed. So I think it's not just that there is a planetary limit to growth. I think it's also about how that value that's created within that planetary system is actually dispersed. And I think until we actually look at that, and that's everything from the way capital is produced. Capital is still produced for example, from a central bank, which then has a network of capital producers, i.e. the banks that are within its system. And it's still the closer you are to the proximity of that capital, and you can use financial centers as a good example. So you have London, New York, Hong Kong, Tokyo, are good examples of very, very concentrated local areas of capital production. Yet, if you look at their distribution of that capital, it's still very much trickled down. And by the time it gets even geographically a geographical distance from where that capital is produced, you've created already the inefficiencies of that capital being dispersed. I tend to use the example of the German banking model after World War II as a good example. First of all, it's a model that's been criticized for decades. Most of the industrialized and advanced economies would love to criticize and remind the Germans that it's a very fragmented, decentralized model, and it's not very efficient, and so on and so on. But we have to understand that after World War II, Germans lost a lot of faith and confidence in their institutions, financial and political, societal institutions. They stopped trusting them. And what the German banking model really is a decentralized, or let's call it a distributed reserve banking model in my opinion. And in recent years now, people are starting to look at it again as an example of, rather than completely wiping and developing a brand new financial system or a monetary system, they are looking at it as perhaps an example of, with a few variations, we could actually take a look at that as at least a model to be served. And what they basically did was they have central banks in each of their 16 states. Those central banks then create capital, produce it, and pass it on to specialized financial institutions that are responsible for growing those areas of an economy. So in Germany, we know that it's one of the automotive centers of competence in the world, and there are development banks and industrial banks within Germany that would focus just on developing and financing the supply chains that are needed in order to have an automotive sector, and so on and so on. So I like to use that as an example of an existing banking and monetary model that is actually decentralized, or more decentralized than it looks.
Thanks. Okay, so we've talked about the problem, we've talked about where we need to go. So now we're on to the really good bit of like, how do we get there? How are we going to do this? And I think that's what a lot of the questions coming through are related to as well. So we will definitely get round to those, don't worry. So yeah, let's talk about how we're going to get there. Raj, I'm going to start with you this time.
So it's actually a good way for me to just continue what I just finished saying, right? Which is, I think the decentralized production of capital is definitely one of the key areas that we do need to understand, and whether we use an existing model and restructure it. But the production of capital is it's less about the actual quantum of capital, but it's actually, where is capital efficiently deployed? And that requires either a more local production of capital, and also requires if it's not a decentralized institution, but it's a decentralized organization of institutions. And I think that's where we first sort of have to sort of take a look at. And the other thing is to sort of democratize the agency of long-termism. I think long-termism does not require centralized, it actually needs to have decentralized or a more democratized way to distribute the organization of the institutions and the mechanisms in order to contract with it. I also think that the long-termism also needs to have, at its core, the contracting of many to many. In order to transact, it cannot be based on a supply-demand, a very commoditized transactional framework. So the assets that we need, whether they're natural assets, any sort of assets that have generative long-term, ultra long-term value, we have to look at how do we account for those. A simple example is an urban tree is always booked on the liability side of a municipal balance sheet, where it's looked at as a cost, completely not taking into account of the generative assets that a tree can be, and therefore the value that we've attached to a tree, and this is why you shouldn't be valuing a tree, is always booked on the liability side. So we need to understand how do we actually account for long-term assets that provide the basis to mitigate the liabilities that we also have. So we do this supposedly so well in the financial markets, where we're able to manage our assets and liabilities. Insurance companies are supposed to be super good at it, managing assets as well as their liabilities. But we need to do that at a societal level, where we're looking at the liabilities that we have over the ultra long term, and understand how do we actually dynamically match those liabilities with the assets that we need to build. And in order to build those assets, we have to do everything from understanding how do we finance those assets, how do we account for the co-benefits that those assets provide, and at the let's call it the civic level, these infrastructures that we need to be built, how do we actually measure and record and account for these? So I think, in order to build a long-termism framework and a society that's based on long-termism, you've really got to change the contracting and the ability to contract in using the infrastructures that are tangible as well as intangible. So it starts off by, how do we record them? What do we value? Do we have the ability to capture the spillover values from long-term assets, which we are not accounting for today, because we're only able to capture the very tangible and short-term things that we actually see in the value that's generated from them.
So just to kind of dig into that a little bit, you talked about some of the systems and what they need to look like. How do we even start with that? I mean, are we talking about new technologies that we need? Does blockchain come into this? I mean, who is making the decisions here to get us to that place that you were just describing?
Sure, and it's probably, and obviously given what's going on with decentralized finance today, this isn't about crypto assets versus, it's the mechanisms of governance, right? At the end of the day, it's really about governance, and governance that is not concentrated or centralized. It's about the many-to-many contracting. Usually, if you look at our legal systems, they're based on, a multilateral contract is maybe 3 people and that's it, or 3 entities. So we need to develop the infrastructure that's needed to be able to transact in a system many to many. And I think that's the key. And the governance of that is also a vertical component that needs to exist across our institutions and others and instruments. So blockchain is a good example of a decentralized mechanism where the decision making and recording and the distribution is more equitable. So I think blockchain is a good analogy. And regardless of, I'll let the technical experts talk about its actual utility, but blockchain's been used in the insurance industry for many years. It's only that it's becoming a household word, obviously due to crypto assets. But that is a good example of a decentralized mechanism for governance, a distribution as well as value creation that is not from a centralized. But what I still don't see is how do we overcome the asymmetries that are involved in the allocation of capital, and also the value that's created and the equitable distribution, the democratized distribution of that value. And I think until we address those, technologies such as blockchain, or let's call it distributed ledger, probably more general way to put it, is where we need to sort of concentrate, building the infrastructure that's needed in order to contract and transact with that and with the proper governance mechanisms.
Thank you. Okay, so we've got 20 minutes left, so I'm going to move on to Anne. So how do we get there? I really want to answer people's questions as well, so we will find time for that.
Sure, Charlene. Right, okay, and maybe I just do a broad overview of how we tackle it here at TDI, and then Jacob, you can also be more concrete on some projects that we have on our pipeline. So actually, this problem with long-termism and short-termism, we wanted to tackle, and that's why we built up a new research stream here last year, 101,000. And with this 101,000 research project, we actually have the goal that we first want to open financial institutions' eyes to see those long-term challenges that they're out there. And for this, we, for example, develop long-term risk metrics or long-term investment metrics, and also do some research on this, as I was referring to some interviews that we conducted. And then the second thing is really that we see, okay, now they can maybe see those challenges, but as I said before, also there is this problem and challenge of uncertainty. So we actually also want to provide the glasses so that financial institutions can actually see and navigate through this complexity and uncertainty of those future challenges, through the use of risk management tools like stress testing tools, for example, or scenario analysis. So we do a lot of approaches here to engage them to see the future and to look at the future. And then the third one, and I think this is maybe also one of the most important ones, is that we also want to prepare and provide the path to mitigate and adapt to these risks, right? And I think here we come into a field of policy and regulations, and how do we actually set the incentives that are necessary that financial institutions do the right thing to benefit also society. But maybe Jacob, I pause here also because of the time, and then you can just pinpoint concrete projects that we have at the moment.
Sure. So I think there's 2 or 3 concrete things, right? One of them is that taxes are a great instrument for a lot of this. And we actually already have some tax incentives in place. So for example, in the UK and Netherlands, there's a differential bank levy on financial instruments with longer time horizons. Now, this is between more than 12 months, so we're not talking here about decades, but with all these things, we always feel like, oh, we don't do, this is not the kind of policy we make, when actually, when we look at the policy portfolio, we see a lot of kind of individual interventions that show the feasibility of introducing long-term issues into things like tax incentives. That's the first aspect. And we're doing some work on that. I think the second aspect, and I saw it in one of the comments, is obviously representation, right? So, having people that have long-term incentives, whether that's a younger generation or whether that's people from outside perspective who can bring some of that, act as kind of the custodians, if you will, of perspectives that are not just over a short-term time horizon. And that's obviously a political aspect. That's not necessarily our core area of expertise, but it would be amiss to not reference that component as well. And then the third thing is, I think a lot about, and I had a lot of conversations with friends about the fact that very few people actually know whether it's legal in their country to cross a red light as a pedestrian. So you just ask yourself this question. Most people kind of think they know, but how sure are you really whether it's legal or not? Would you bet your life on you knowing the fact? And even if you did know, could you tell me what the fine was if it was illegal? Is it 5, 10, 50, 100 euro? And I think it's the reason why I think this example is interesting is because it's something we do every day, but where the actual law has a pretty marginal effect on how we interface with this issue. But it's, by the way, incidentally, illegal in France and Germany, but anybody who's been a tourist or who lives in those two places knows that the culture around crossing a red light is fundamentally different in those two places. So I do think that an important part of that is culture. And one of those pieces of culture is actually accountability on saying, if you're a long-term investor, what does that mean? What is the definition? Making that a regulated term in communication and marketing. Right now, you can call yourself a long-term investor. There's no consequence. We've found 3,500 references to the word on the top 20 asset managers' websites, but there's not a regulated term. So you can call yourself long-term, short-term, blue, green, white, doesn't matter. So these kind of things matter, not in the sense of creating a specific regulatory incentives, but creating a incentive not that is monetary, but cultural, a cultural incentive that creates accountability around that. And I know that sounds vague sometimes, but if I go with my red light example, that can be just as powerful as hard-nosed tax changes to tax codes that we like to think of as sort of the pinnacle of policy ambition.
Great, that was a really good example, thank you. Richard, do you have anything to add?
Yeah, I guess a couple of comments and lots of interesting stuff in the chat. So let me try and kind of deal with a few things that are coming up there. And actually, I think so somebody earlier referenced the need for a movement, and Manoj, you just put in a comment about when it's everybody's problem, it's nobody's problem. And I think that really gets to the core of what we're trying to do here is we have to find new and different ways to act collectively if we're to trigger this shift in the system that we're talking about. And I also love studying history, and Raj talked about looking at the German banking system after World War II as an example. I think we can learn a lot from the movement that has fundamentally transformed capitalism around the globe over the last 50 years. Unfortunately, that has nothing to do with limits to growth, and it has everything to do with other views that are probably most often labeled as neoliberalism. But what you see there is an incredibly effective movement that both had an intellectual wing and a very strong kind of policy entrepreneurial wing that very effectively shifted the rules of the game in a way that favored liberalizing markets across the board, deregulating. And whether you agree with that agenda or not, what is undeniable is that it has been incredibly effective at changing the kind of capitalism we have, both in terms of the rules and in terms of the culture. And I think there's a lot we can learn from movements like that to understand what was it that enabled that movement to be so successful at reshaping rules and norms. And it was a lot of different things. It was partly opportunism. It was being ready with ideas when various crises struck, particularly in the 1970s. You know, we've talked a bit about the monetary system. 1971 is US unilaterally effectively called time on the Bretton Woods monetary system by ending the dollar convertibility to gold. That created that was partly a response to an international monetary crisis and created this vacuum. Now, frankly, the neoliberals had quite an easy sell here, because their message to the Nixon administration that had just decided to do that was basically, don't worry, it's fine. We'll go to free floating exchange rates. Let's rebrand this. What you've lost control of the system. That's a good thing. So that was an easy sell, but they were opportunistic. They had, you know, people like Milton Friedman had ideas for how you control inflation at a time when inflation was spiraling. We're back there again now, potentially. Now, again, I can see people shaking their heads, whether you agree with his ideas for how you control inflation or not, and whether the cost was worth paying, that's a different question. But the point is, they had ideas that met the issues that policymakers were dealing with there in that moment, in that time. And I think, again, we have to respond in a similar way of whether you see this as a planetary boundaries movement, where you see it as a long-termism movement. We need to act in a more coordinated fashion as a movement, and we need to have answers to the problems that policymakers are facing today, and those need to be really kind of ready to go answers that are on the shelf, not guiding principles. And that's why, you know, some of this groundwork is really important, but we're not there yet by any means. Just also to comment on, because I saw a bit of an exchange after Raj's point about decentralized finance, and somebody making a point about, do we not in this instance, it was Dominic, need centralized direction setting. And I think here it's not an either or thing. One of the things we set out in the paper we'll be releasing later this week is the need for both interventions that are about transforming the core of our existing system, and that's where some of the stuff that Jakob's talked about in terms of using the tax system to incentivize behavior change. I saw Ross put in a comment about incentivizing longer holding periods for investors. There are lots and lots of tweaks we can make to the existing system, and that includes looking at what central banks are doing today, and the huge impact that monetary policy has both on the distribution of wealth in society, but also on the kind of growth and planetary boundaries question. And that doesn't preclude us from, at the same time, running some of these experiments at the edge that are about investigating totally different models of capital production that actually circumvent our existing system of central banks. And I think we need both core and edge, and at the same time, we need that coordination across the two. Last thing I'll say on this point is, I also seen some of the comments about efficiency versus resilience in the chat, and I think this is a really important point, because a lot of the and I appreciate there's nuance here about what do we mean when we talk about efficiency, but it's right that when we've talked about efficient markets, making markets more efficient, which has been one of, in a sense, the driving factors behind a lot of the change we've seen over the last 50 years, we have been defining efficiency there as how to maximize return on capital right now. That's the very narrow definition of efficiency we've got, and we're seeing all the signs now that has led to there is a trade-off between efficiency and resilience in our financial system, and that spills out into the real economy as well. And we know we need to rebalance now towards greater resilience, and that does mean giving up some of the so-called efficiency, at least, that we have built into our market system. And that's partly why even things like financial transaction taxes and stuff like that is, part of the rationale there is, in effect, throwing some grit in the wheels and saying, we actually need to make our financial system a little bit less efficient in the terms that we've come to to define efficiency. We need to slow it down, because the trade-off from efficiency is resilience and is patience. We need that, going back to Ross's point, we need longer holding periods. We need patient capital to invest in businesses that are going through a transformation towards greater resilience and ultimately, we think, regeneration in their own business models.
Thanks, Richard. So we talked a bit about tax incentives, regulating the term long-term or long-termism. I mean, what other kind of specific things can we do to drive long-termism, and what is actually coming through that will help drive it as well? Someone mentioned TCFD, climate risk reporting. Is that, and that's going to be mandatory in the UK, right? Is that going to help? What about the move towards double materiality in the EU? So giving equal weighting to financial and sustainability outcomes. Is that going to help? Can we talk about some of the specific things coming through and new things that we could be calling for that will help drive a more long-term view? Can I start with Anne on that one, perhaps?
Yes, sure. Thanks, Charlene. So let me try to answer the question, like, in a sense. So I think, like, with the question of, like, if double materiality, for example, will, like, solve the problem or not, I think, like, it's really, like, the question, okay, like, how do we get the financial institutions involved, right? So let's see, like, we focus on the financial institutions because we say, okay, they play, like, a double role in that regard, right? So first, they are exposed to those long-term risks, so that's why they matter and that's why they care. But then again, like, we want them actually to finance those changes and those alternative ways of, like, yeah, that the system then can change and will change as well. Like, now really, like, looking on the financial system here as well. So in that regard, like, double materiality, I think, like, is just a very good way of, like, how to communicate with them, and, like, maybe to reach the stage of, okay, hey, they care and they want, like, they see that's a problem. But then I think the question really is, okay, how do we make the shift then from this risk-based stage to a value-based stage, right? Like, where it really comes to financing it or not. And I think in that, like, this shift here, I think will be, like, a very, very big challenge for all of us who are working in that field. And I think it's also maybe something about, like, okay, we need really to engage them with the future, and maybe there could be something like simulations games or some scenario analysis, like, just to use some of our methodology or tools that really make them envisioning the future as well, like, also not only financial institutions but also policymakers. And when they then see what might or what can happen in the future and how like, we are all exposed or not, it might, like, really, like, drive also the change that they come into this value-based stage of sustainable finance and not, like, stay in the risk-based field. So yeah, but I'm happy to also hear Raj or Richard or Jacob's question, like, answers to this.
Raj, you've unmuted. Go for it.
Thank you. I think I still want us to go back to, until we price the long-term liabilities and until we actually price those, I think really everything else is just on the periphery. And I think it's not enough, because if I am the emitter of 1 metric ton of carbon, do I know what actually the true liabilities are associated with that to society? So if I'm an emitter of just 1 metric ton of carbon or carbon emission, as an emitter, there are liabilities associated with that, and also there's a time value in that. And this is where time value, even if you model it as a derivative, the theta of that is huge, and the risk associated with that is massive. So one is, I think we still really need to not just acknowledge what the liability associated with, for example, emitting one, but also to crystallize that liability. You know, we have lots of regulatory instruments for publicly traded companies where if I become over leveraged and my balance sheet, shareholders can penalize me. I can become technically insolvent, which means that I would have to then be forced into a bankruptcy proceedings. But there's no regulatory instrument today that will make me crystallize the liability of emitting 1 metric ton of carbon and then escalating that liability where on my balance sheet, I've got to do something about it. I've got to do a lot of other things on my balance sheet, but I actually don't need to care about that today. So I guess I'm implying in one sense is that you, apart from pricing the liabilities, crystallizing those liabilities, and then understanding what you need to do, either by incentivization, and there's many carrot and stick paradigms out there. They're nowhere near until you actually, and that's how you would incentivize. The other thing is in capital allocation, I should be right today. We know that mathematically, if I want to allocate capital, due to my own IRRs and other objectives, I need to, if I'm looking at investing in a solar farm versus an oil production project, it's going to be the oil production to give me my. So again, just going back to what are the incentives? What do you have at hand? What are the instruments that you have at hand to cost the liability, the risks associated with it, and then what incentives do you have to go the other way? So I think it really is, it's a bit more fundamental. Yes, we can do, value risk was invented, now about 30 years ago, to give decision makers in financial institutions a number, with all the mathematical models behind it, but really a number to say, how much money can I lose over a 1 day, 1 week, 1 month, and maybe 1 year holding period, but nothing more than that. So things like climate VAR, they're just simply I think a diluted version of something that's been around and really effectively still hasn't stopped financial institutions from going insolvent. I just think that we need to look at what we've done in the financial sector and start to understand how do we crystallize those liabilities, and also to force some kind of enforcement mechanism to say that it's in my best interest to de-risk my balance sheet, just like I do when it comes to debt and so on and so on.
Thanks. Richard, do you want the last word before we call time?
No, I mean, I'm not sure I can beat Raj's eloquence. I absolutely agree about the point that we have to price those long-term liabilities, and everything else is risks being tinkering around. That said, some of the tinkering is worth doing nonetheless, but yeah, I think that's a good place to end. Yeah.
Well, look, thank you so much. I feel like that flew by and we haven't captured everything that we'd like to. It's such a big topic, but do let us know if you'd like us to have a conversation on this topic again, because we absolutely will. There's lots to explore. But for now, thank you so much for joining us. And yeah, we'll share the video, we'll share the chat, and we look forward to seeing you next time. And thanks so much to our speakers. Thank you, Raj and Jakub and Richard. Thank you.
Our pleasure. Thank you very much, everyone. Great.
Thank you all.
Bye-bye.
Bye.